Welcome to the Robert Hunt Financial Market Update. It's your host, Robert Hunt, where I look at the week's financial news that it can be a bit confusing, misleading, and take you off course and help to make it actionable, understandable, and clear. What a week. Very hot here in Dallas, and yet what a show. We've got, this is the proverbial week, some great articles. We're going to be looking at a Wall Street Journal article, hot new funds that are boomer candy for retirees. We're then going to be looking at the Americans chasing high interest rate risk falling into a cash trap. Another great Wall Street Journal article. We then will have time. The producers are pushing me on this, and I've listened. We will have time for Robert's Corner, where I talk about my own mold remediation journey and the analogies for your personal finances and mine as well. So you're going to want to listen to the end to see how I connect those two disciplines. So at the top, these hot new funds are boomer candy for retirees. Subheadline, derivative strategies and ETFs allow investors to chase stock returns while also protecting against a potential market downturn. This is by Mr. Jack Pitcher. Anytime you hear it promised that you get something while not having to deal with the typical negative effects, you should be on high alert. This is no different. So the article explains that baby boomers, it reads, who aren't ready to walk away from the stock market are flocking to a hot, new class of funds that seek to ease the pain of its swings. Ease the pain of the swings. So what they're telling you, and these products aren't the end of the world, mind you, but let us be on alert whenever someone says, hey, are you struggling a bit with the volatility in the stock market? Does that bother you at all? Of course, the answer is yes. Nobody wants to see their portfolio go down 10%. Here comes the sales pitch. Oh, yeah. Why don't we keep the upside and eliminate the downside? Okay. Well, that's what some of these products do. And again, not the worst products in the world. They're more expensive. But one example this article gives is they call it the equity premium income. It invests in a portfolio of large cap stocks, those big companies, while also selling options contracts on those shares. Covered call type strategy. The funds generate a higher dividend income than is typical in a stock fund, sometimes 8 to 10%. And that's true. I've seen 8 to 10%. But they also cap investor gains and carry chunky fees. And when you watch these funds over long periods of time, they don't go anywhere. They don't go anywhere. Mr. Eric Balkunas, who is the gentleman who gave us the term boomer candy, says there is a similar class of funds that even advertises 100% downside protection when certain conditions are met. These are called buffer funds. They guard against losses up to a point while limiting potential gains as well. And Mr. Eric Balkunas says, hey, he uses the term boomers. He says the baby boomers, like to be in the stock market but want the protection that helps you sleep at night. A good chunk of the ETF industry is in the lab. This is always scary. A good chunk of the ETF industry is in the lab trying to design more of these funds as we speak. Now, listener, whenever someone tries to give you a product like this to help you sleep better at night, be thinking, that's the quick fix. That's the sugar rush, sleep well at night. The true sleep at night is actually investing in your education, listening to the podcast, reading the books. The product isn't going to do it for you. And ultimately, there are only so much return you can squeeze out of the market. I don't care how much financial engineering you apply. It'll always be, you show me how much it costs, I'll just deduct that from the return. And these strategies cost more and, oh, by the way, are less tax efficient. And there are different ways to manage some of these concerns. So the article explains, and this is important data. It says boomers and other investors say they can't give up on their stocks because of FOMO, or fear of missing out. And this data is interesting. The S&P 500, that's those 500 American companies that are representative of the economy, has logged a total return of more than 980% since U.S. stocks bottomed in March 2009. That is a lot. The Bloomberg U.S. Aggregate Bond Index total return is 50% over the same period. So you can appreciate why someone would say, the historical vehicle for smoothing out volatility, particularly for those in retirement, has been bonds. But if you want it all, here comes a product for you that I don't recommend. And this article lists various options you have, et cetera, et cetera. Here's what can go wrong, and I am glad for this journalism that includes that. Some of these strategies, they may not work in periods of extreme market stress. Yeah, like any of this engineering, if stressed hard enough, can break. Now, it doesn't happen a lot, but it's something that you and I should be aware of. It may not work as designed, but you certainly know if you just own a plain old vanilla index fund, it'll work. Maybe more volatile than you like, but it'll work. So, no surprise, this violates one of our keep it simple strategies. Mainly that lovely mandate to keep it simple, but that strategy to keep it simple. Whenever we diverge off of that, we can find ourselves in unpleasant waters. I actually don't think this is the end of the world. If I saw this in a portfolio, what I wouldn't say is, sometimes I say that when I see products. I wouldn't do that if I saw this. I would just probably ask some tough questions about tax efficiency and fees. So you don't need to do this. Do not be scared of the volatility. Keep it simple. Next article by Miss Vicky Gewang. Headline, Americans chasing high interest rates risk falling into a cash trap. Subheadline, investors must decide whether to sit on their cash or redistribute it ahead of expected rate cuts. So, starts out, Mr. Bob McGovern is in no rush to move his cash. The 66-year-old retired banker and his wife have about 60% of their non-retirement assets in treasury bills and money market funds that are paying yields of around 5%. Well, they do have plans to buy a second home in a warmer area, and they're going to keep it there until the Federal Reserve cuts. Mr. McGovern says, until then, I'm just going to keep it in cash. I like the safety. He's not alone. Check this out. Article explains Americans have poured money into cash-like investments since the Fed began their raising their interest rates, driving assets in money market funds to a record $6.12 trillion with a T, $6.12 trillion earlier this month. So I'm seeing this quite a bit. The folks who are probably a little afraid of the market for whatever reason in the zero interest rate world that we had a couple of years back, it really forced them to invest. Now that cash is yielding more, those same people are all too quick to want to go to cash and then hang out in cash. Now, our friends at JP Morgan Asset Management call it a cash trap. So what they're saying is, and this is John Croak, says if you've owned cash for the last year and a half, that view in the rearview mirror is pretty attractive and you feel good about yourself. So, and I'm sorry, this is John Croak, head of actively managed bond products at Vanguard. It's like being head of expansion of democratic efforts in the Saudi kingdom. I never dreamed you'd read that, but so it is, guys. Vanguard's preaching all sorts of things. So, but you have to remind yourself it's in the rearview mirror. I actually agree with this gentleman. We are looking in the rearview mirror at these higher rates for cash and thinking, hey, this is great. I'll just hang out here, particularly those personalities who are fearful of what is to come in the market. They are all too quick to want to hang out in cash, wait for the Federal Reserve to drop the interest rates. Here's the problem. You're engaging in market timing. Now, you may not say you're engaging in market timing. You may not think you're engaging in market timing, but you are. And instead of hopping into cash when you think rates are up and then deciding to leave, who knows when that'll be? No one knows. No one knows. It is a better idea to simply keep a plan, keep an asset allocation, and stick with it. One of my favorite people is quoted in this article, guys. Mr. Cody Garrett, a financial planner at Measure Twice Financial, says another problem with holding long-term investments in cash, inflation is likely to chip away at its value after 3 years. This guy is one of my favorites. I'm so glad he's in here. Inflation. So at least when you're in risk assets like stocks, you get a tailwind usually from inflation. You have productive assets. When you hang out in cash, over time, you are going to watch the value erode because you just can't keep up. Cash over the long pull has not been able to keep up with risk assets. So, gotta push yourself to get out of this. And then I think this is a timely, poignant quote here. The article explains some investors cite reasons other than attractive interest rates for sticking to cash. Frank Hammond, a 72-year-old retiree in Pittsburgh, said he is nervous about November's presidential rematch between President Biden and former President Donald Trump. Geopolitical tensions, including escalating conflicts in the Middle East, are another reason for worry. He says if rates go below 4%, it won't trigger me. I think that we're in for some real turbulence in the markets. So no surprise, what's coming from me is you go back and look at the data, and I know it's on everyone's mind, on whether the stock market does better under presidents of the Democratic Party or presidents of the Republican Party, and there is no discernible difference. Now, that's typically a shock to people, but politics in the United States moves slowly. Changes don't actually get baked in that quickly, and so it's not actually a very helpful data point to follow politics with your investing. Now, of course, there are big things like private property rights and patent law. There are so many things that contribute to a country's ability to increase their gross domestic product, and in so doing, their various companies, the value they have in the market. But don't look to short-term political solutions for buy and sell signals, which I know we may not admit to doing that, but when we focus on politics, we can do it even subconsciously, where you just think, hey, I'm feeling a little negative, feeling a little pessimistic, and oh, by the way, there's this uncertainty politically. I'll just camp out in cash. Totally understandable why someone would think that, but in this article, they list other, Miss Vicky Gewong lists other examples that do show other folks over-allocating to cash. And what I can tell you, just as a practitioner, it is really hard once you over-rotate into cash. Let's say you have 50% of your portfolio in cash. When do you go back? It actually is tough because what can happen is, let's say the stock market keeps going up. All of a sudden, you're in the unenviable position of, oh dear, when do I get back on this train? How am I supposed to do this? And you've given yourself another decision point that you have to mess with. The whole goal, at least that I have with clients, is to eliminate decision points, to have as few as possible. I think that gives you better results. And then in Robert's Corner, where we connect the most disparate of disciplines, mold remediation. It was one of those things where there was a small leak I didn't even see. Someone installed something incorrectly in the flooring, and there's a small little leak year after year after year after year. I see the wood warp a little bit, and I think, I wonder what that is. It takes someone else, not me, and that interesting, someone else has to say, hey, Robert, I actually think the wood warping could be something else. I thought my kids maybe spilled a bowl of water, didn't clean it up in time, water damage. But I have that third party, someone a little more objective than me not wanting to spend the money, come in and say, yeah, this reminds me of water damage. I have to bring in another expert who tells that to me. I still don't want to hear it. I have the folks who ripped it out today. They are showing me pictures, and I'm just now getting it. The doubting Thomas in me has finally seen, oh, yeah, I guess I really did need to do this, even though I didn't want to. And what it emphasized to me is the importance of having outside objective voices with, yes, mold remediation, but of course your personal finances. It is all too common. I saw it myself with this whole mold remediation process, dragging my feet the whole time, thinking there was another solution, not realizing the longer I had waited, the more damage that was going to occur. So in Texas, they separate the person that identifies the mold, the person who remediates the mold. I think there's wisdom there. Had I just let it sit and done nothing with a bad setup, I like to keep it simple, but if you keep it simple with poor setup, it is no good. It would have gotten worse and worse and worse. Rot, more and more. I see it in personal finances in these ways. The first is complexity. So there is an aversion to simplicity with many folks. It can happen to me as well. The more complexity you introduce with, it doesn't matter what it is. Let's say it's 4 or 5 credit cards. Let's say it's way too many investment funds. Let's say it's spreading your money out between way too many banks. Leaks occur. I see more and more financial leaks, meaning a financial leak is when you're not optimized. You're at too many banks, so this bank isn't paying you interest, but you're not thinking about it. You're in too many investment products, so you can't watch everything. It's tough to. A rule that I like to give when I'm encouraging clients to simplify their investments is I say, well, close your eyes, and I want you to, as far as you're able, describe your investing setup. Can you name your funds? Can you name the amounts in the funds? Can you name your banks? Now, most people struggle with this, and that's by design. I give a lot of grace. I say, hey, of course it's hard. We want to get to the point where with our eyes closed, we can actually name the prices we're paying for these funds. We can name the banks we're at. We can name the interest rates we're charged, name the interest on our deposits. So that's one of those. That's a wood rot in your finances. That's that slow leak that you look at and go, oh, yeah, I guess so. And then just not. So that's an area. Focusing more on your investments, not having a 50-year plan. So it is really difficult when this is related to the other article, when you give yourself too many decision points. It's a form of financial rot because it's paralysis. So, hey, it's time to do something. There are times, even in the simple financial plan, there are times where you have to rebalance. There are times where you need the cash. You have to sell a certain security. Think about how difficult those decisions are when you have a lot of buttons on the table, a lot of things you got to mess with to have a clear decision, especially when you're trying to make a decision as a couple or as a family. So it's tangential to that first one, but that complexity can breed financial rot because all of a sudden you are going to be paralyzed and you are going to be tempted to just rock along. Hey, let's not make any changes, which I can understand why people would say that. Let's not make any changes. Let's not do anything we don't feel like we're comfortable doing. Over time, rot. Because those high expense ratio funds are tougher to sell later in life. The unrealized capital gains are high. You get a tax hit you really can't make sense of. So don't be like Robert Hunt and his mold remediation. Be willing to look early. The earlier you're able to catch financial rot, the easier it's going to be on the cleanup side. And it's always something that can be cleaned. No matter, even if, let's say you think you've got too much rot. It's never too much rot. You can always cut through it. It takes longer. It's harder. But you can always cut through it. So let's keep, as always, it's cost low, that investing simple, that time horizon long. Until next time.